Okay, so you want to own a casino. You buy a large building, fill it with slot machines and gaming tables, let people walk in with their own money, and rely on mathematics to make sure that some of it stays behind when they leave. Unlike a restaurant, you do not have to guess whether customers will like the food. Unlike a store, you do not have to predict which products will still be fashionable next year. The rules of every game already favor you. The longer people play, the more likely you are to win. It sounds like the closest thing business has to a legal money printing machine. And at the level of a single roulette wheel or slot machine, that picture is not entirely wrong. The problem is everything surrounding the game. The building that cost hundreds of millions of dollars. The hotel rooms that have to be cleaned whether they were sold at full price or given away for free. The restaurants that stay open late with half the tables empty. The dealers, bartenders, security officers, surveillance teams, cashiers, technicians, accountants, hosts, and compliance employees who need to be paid every week. The taxes charged on the money the casino wins, the interest charged on the money used to build it, and the uncomfortable fact that a casino can hold a mathematical advantage over every player in the room and still lose enough money to go bankrupt. The house usually wins the game. The owner still has to survive the business. Before we talk about profits, we need to separate several businesses that all use the word casino. A small locals casino near a highway depends on repeat customers who live nearby. A tribal casino in a rural area may be the only major entertainment destination for miles. A large resort casino contains hotel towers, restaurants, theaters, nightclubs, convention space, stores, and a gaming floor that occupies only part of the building. All of them offer gambling, but financially they sell different products. The locals casino sells convenience. The destination resort sells an entire trip. That distinction matters because in a modern resort, the casino floor may not even be the largest source of revenue. So let us start with what it costs to get in. A small gaming hall can require tens of millions of dollars. A major integrated resort can cost several billion before the first guest checks in. Land is only the beginning. You need parking structures, hotel towers, commercial kitchens, elevators, backup generators, ventilation, surveillance rooms, employee areas, secure cash cages, data centers, and thousands of miles of electrical and communications wiring. Every slot machine has to connect to systems that track wagers, payouts, jackpots, errors, and suspicious activity. Every table sits beneath several cameras. Every hallway carrying cash has controlled access. A casino floor is expensive because nearly every square foot has to be powered, monitored, and protected. Then there's the hotel. Thousands of rooms, bathrooms, locks, carpets, and climate control systems begin wearing out from opening day. Guests compare you with the newest resort nearby, so room rates can fall long before the debt payment does. Casino owners do not build once and collect forever. They keep renovating a property that can become commercially outdated while the concrete is still sound. But even if you have the land, the financing, and the plans, you still do not have a casino. You have a building that might one day be allowed to contain one. Gaming licenses are not ordinary business permits. Regulators investigate the owners, managers, investors, and source of capital because casinos move enormous amounts of cash, issue credit, and process transactions that can reach millions of dollars. In the United States, large casinos are treated as financial institutions under anti-money laundering rules. They must identify major cash movements, recognize suspicious behavior, and preserve detailed records. A serious failure can bring large penalties or threaten the license itself. Remove that license and the slot machines become expensive furniture. So before a single player arrives, you have spent money on construction, equipment, lawyers, investigations, technology, training, and working capital. The casino cage needs enough liquidity to redeem chips, pay jackpots, and survive short-term swings in customer luck. Your inventory is money, and every customer expects it immediately. Now the doors open, and the famous house advantage finally begins to matter. But the amount wagered is not the amount earned. A customer can place $100 into a slot machine and wager the same remaining balance again and again, creating several $100s of recorded activity. If players wager $100 million and receive $92 million back, casino win is $8 million. The property processed $100 million and kept $8. What matters is not how much money moved, but how much remained after winning bets were paid. Every casino game is designed with a mathematical advantage for the operator, but the size of that advantage varies. A skilled blackjack player can reduce the house edge, while a careless player can give the casino much more. Roulette has a built-in advantage created by the green spaces on the wheel. Slot machines are configured around a theoretical return measured across an enormous number of plays. Baccarat can carry a relatively narrow edge on common bets, but generate huge volume because wealthy customers wager large amounts quickly. The important phrase is across an enormous number of plays. The house advantage is a long-term expectation, not a promise about tonight. A roulette wheel can lose money for an hour. A blackjack table can lose money for an entire shift. A casino can lose millions to one customer during one weekend. The mathematics becomes more reliable as the number of wagers grows, but the owner has bills due long before probability fully settles. This is why high rollers are valuable and dangerous. One guest can generate more expected revenue than hundreds of ordinary players, then leave with an 8-figure win and damage the quarter. The games still favor the house, but the customer may never return long enough for probability to reverse the result. The casino also estimates what each customer should lose over time using the game, average bet, speed of play, and length of the session. That theoretical value determines whether the player receives a free room, dinner, show tickets, transportation, free play, or a personal host. The guest sees generosity. The casino sees customer acquisition cost. A suite advertised at $1,000 may cost far less to service when it would otherwise sit empty. The same is true of a complimentary meal. Casinos use the gap between retail price and actual cost to make rewards feel larger than the sacrifice. But competition can turn that system against the owner. If one resort offers a room, another offers a suite. More of the expected gaming win is returned through promotions, meals, gifts, and free play. The game keeps the same house edge while the business margin shrinks. This is why the customer database may be more valuable than the roulette wheel. A player's card records visits, games, betting patterns, offers, and spending. Two people can lose the same amount and receive different rewards because one has a long history of predictable visits. Machines can be copied. A relationship with thousands of repeat customers takes years to build. In a modern destination resort, rooms, restaurants, bars, concerts, conventions, stores, spas, parking, and resort fees can collectively produce more revenue than gambling. The casino floor is part of a system designed to increase how many people arrive, how long they stay, and how many ways they spend. A convention fills rooms on weekdays. A concert creates parking, dinner, and hotel revenue even from visitors who never gamble. A restaurant with a weak direct margin may still keep valuable players inside the building. A show may barely cover its own cost while filling hundreds of rooms. The departments constantly transfer value between one another, and the only number that matters to the owner is the cash left after the guest goes home. And now we reach the other side of the ledger. A large casino resort operates continuously. The gaming floor does not close at 10 in the evening. The surveillance room does not go dark when traffic slows. The cage cannot be left unattended. Security must be present at 3 in the morning. Hotel guests need assistance at all hours. Machines fail at inconvenient times. Cash has to be counted, transported, recorded, and protected. Labor is one of the largest expenses. Dealers, slot attendants, cocktail servers, bartenders, cooks, cleaners, engineers, hotel employees, security officers, surveillance staff, marketers, hosts, accountants, auditors, compliance specialists, technology teams, and managers all support the same operation. Many roles require specialized training or licensing. A casino cannot remove most of the security team because Tuesday is slow. It cannot stop monitoring transactions because occupancy fell. The minimum safe and legal staffing level creates a floor under expenses. Food and beverage add another layer. A large resort may operate quick service outlets, fine dining restaurants, bars, room service, banquets, and employee cafeterias. Ingredients spoil. Kitchens consume energy. Restaurants need staff before the first guest arrives and after the last one leaves. A crowded restaurant can still produce a thinner margin than gaming, but closing it may make the entire property less attractive. The hotel creates the same tension. Empty rooms require less cleaning, but the building still needs climate control, maintenance, front desk coverage, security, reservation systems, and capital spending. You can reduce some variable expenses when occupancy falls. You cannot shrink the tower. Utilities are enormous. Casinos use extensive lighting, digital displays, kitchens, laundry systems, elevators, servers, surveillance equipment, ventilation, and climate control. The gaming machines themselves require power and network connections. Maintenance never stops. Slot machines need parts and software support. Carpets wear under constant traffic. Hotel bathrooms leak. Restaurant equipment fails. Surveillance systems become outdated. The gaming floor must be redesigned as customer preferences change. The owner keeps reinvesting in an asset that can look old long before it is structurally old. Then there are taxes. Gaming revenue is taxed separately in many jurisdictions, and the government generally takes its share from casino win, not from the final profit left after debt payments and renovations. That means the state can collect money during a year when the owner earns very little. Add property taxes, payroll taxes, licensing fees, and other local charges, and the government becomes one of the most consistent winners in the building. Debt is where the model becomes dangerous. Almost nobody builds a billion-dollar resort entirely with cash. The project is financed through loans, bonds, leases, or some combination of all three. Interest starts accumulating before the property opens. Every construction delay extends the period during which the project pays financing costs while producing no revenue. Once the casino opens, the debt payment does not move with customer traffic. If gaming revenue falls by 20%, the lender does not reduce the payment by 20%. This is the central vulnerability of owning a casino. Much of the cost structure is fixed, while the revenue depends on discretionary spending. People can postpone a casino trip, shorten their stay, gamble less, choose a competitor, or stay home and play online. The building cannot choose to become smaller when they do. Because casino projects are often built around optimistic forecasts, a modest revenue miss can create a severe cash flow problem. Suppose a resort is projected to generate $500 million a year and is financed around that expectation. If it opens and produces $400 million, it missed the forecast by only 1/5. But if the original model left just $50 million after operating costs and debt service, that $100 million shortfall does not reduce profit slightly. It erases the entire cushion and creates a large loss. This is how enormous properties can fail, even while attracting millions of visitors. The question is not whether people came. It is whether enough profitable people came at a cost the resort could afford. High-end gaming creates another risk: credit. Casinos issue markers to approved customers, which encourages larger play, but also turns the property into a lender. $1 million won from a player is not $1 million in the bank until the marker is repaid. Some customers default, creating collection costs, bad debt, and legal disputes. Fraud and theft add another layer. Cameras, auditors, controlled chips, separated duties, and cybersecurity do not attract a single guest. They are simply the price of protecting the money the mathematics says you should win. So far, we've assumed the customers already exist. This is where many casino investments fail. A gaming license can restrict competition, but it cannot create demand. Developers look at the population within driving distance, estimate how much those people spend on gambling, and assume a new property can capture a predictable share. Sometimes that works. The casino saves customers a long trip and becomes profitable quickly. Then the neighboring state notices the tax revenue and legalizes casinos of its own. A competitor opens closer to the same customers. The original property loses the geographic advantage that justified the investment, but its debt remains exactly where it was. Casino markets can move from scarcity to saturation surprisingly fast because governments are attracted to gaming taxes. One casino is approved as a special development project. Then another region wants the same benefit. Then racetracks receive gaming machines. Then online gambling expands. Each decision looks local, but together they divide the same customer spending across more operators. This is what happened to Atlantic City. For years, it benefited from being one of the few legal casino destinations available to a huge population in the northeastern United States. Customers traveled from surrounding states because there were limited alternatives. Then casinos expanded in Pennsylvania, New York, Maryland, Delaware, and elsewhere. A customer who once spent an entire weekend in Atlantic City could drive a much shorter distance to a regional casino. The city lost part of its monopoly, and several properties built for a larger market were left fighting over a smaller pool of visitors. The clearest example is Revel. Revel was supposed to represent the future of Atlantic City. It was a glass luxury resort rising above the boardwalk, with hotel rooms, restaurants, nightlife, entertainment, and a premium identity intended to attract guests who wanted more than gambling. The project cost approximately $2.4 billion. When it opened in 2012, it was the first new casino in the city in years, and one of the most ambitious developments Atlantic City had seen. On paper, the strategy resembled modern Las Vegas. Do not compete only on slot machines. Build an experience. Attract affluent visitors. Make the casino one part of a larger trip. The problem was that Revel did not open in the market imagined by its designers. It opened in the market that actually existed. Atlantic City depended heavily on regular gamblers, many of whom wanted convenience, familiar rewards, smoking areas, buffets, bus programs, and a direct path from the entrance to the gaming floor. Revel initially offered a different experience. The property was entirely smoke-free. It did not begin with the conventional buffet expected by many regional customers. Its casino floor was elevated above ground level rather than immediately greeting visitors near the entrance. Its prices and atmosphere felt more upscale than much of the existing market. The building assumed customers would adapt to the property. Instead, the property eventually had to adapt to the customers. But adaptation takes time, and a heavily financed resort does not have unlimited time. Revel attracted attention, but not enough profitable volume. Less than a year after opening, it filed its first bankruptcy and transferred control to lenders while removing a large amount of debt. It changed policies, adjusted marketing, and tried to appeal more directly to the market. But restructuring debt does not automatically repair demand. Regional competition continued growing, Atlantic City weakened, and Revel entered bankruptcy again. It closed in September of 2014, little more than 2 years after opening. Think about that. A resort that took years to plan, cost roughly $2.4 billion, and was built to operate for decades, survived as an open casino for only a little more than 2 years. The building did not collapse. The slot machines did not stop working. The house advantage did not disappear. The financial structure reached the end before the physical structure had properly aged. The property was eventually sold for approximately $82 million, a small fraction of what it cost to build. That did not mean the buyer received a simple bargain. An empty resort still needs security, maintenance, insurance, utilities, regulatory work, and enormous additional capital before reopening. The purchase price was low because ownership had already proved expensive. Revel's failure was not one bad roulette table. It was a chain of assumptions. The project assumed the market would support the debt. It assumed luxury positioning would create enough demand. It assumed customers would accept a different product. It assumed the surrounding region would continue sending gamblers to Atlantic City. When several assumptions failed at once, the mathematical advantage inside the casino could not save the company around it. The building later reopened under a different name and a different capital structure, which reveals one of the most important rules in this business. A casino can be a terrible investment at one price and a workable investment at another. The same building that cannot support billions in construction debt may function after being acquired for a fraction of that amount, renovated selectively, and operated with lower obligations. The walls do not know what they cost. Customers do not care what the first owner borrowed. Capital structure decides whether the revenue is enough. Now imagine a large regional casino resort with slot machines, table games, several hundred hotel rooms, restaurants, entertainment space, and structured parking. Suppose the total cost is $350 million. The owner contributes $140 million and borrows the rest. In a stable year, gaming produces a little more than $200 million in revenue after winning wagers are paid. The hotel, restaurants, bars, entertainment, parking, and other services add roughly $90 million. Total property revenue approaches $300 million. From the outside, that looks extraordinary. But payroll consumes tens of millions. Food, rooms, and entertainment have direct costs. Marketing, free play, loyalty rewards, and complimentary services consume more. Gaming taxes take their share. Utilities, repairs, technology, surveillance, insurance, compliance, and administration keep accumulating. Interest and rent obligations do not stop. The owner also has to reserve money for renovations and replacement of machines, rooms, carpets, kitchens, and building systems. After all of that, the property might retain only a little more than $10 million in cash. That is a real return, but it is nowhere near the fantasy suggested by a room where every game favors the house. Now consider the bad year. A competitor opens closer to a large part of your customer base. Gaming activity falls. Promotional spending rises because you are trying to stop loyal customers from switching. Table results land below expectations. Hotel demand weakens because fewer guests make overnight trips. Restaurants lose traffic. Entertainment tickets require discounting. Revenue falls by almost $60 million. Can you remove $60 million of expenses? No. You can reduce staff hours, food purchases, marketing in weak segments, and some entertainment spending. But the debt remains. The surveillance room remains. The hotel tower remains. Insurance remains. Maintenance can be delayed, but delayed maintenance becomes a larger bill later. Instead of producing cash, the property loses tens of millions. The games still favor the house. The business loses money. 2 years like that force the owner to contribute more capital, refinance at worse terms, sell the property, or restructure the debt. If the building also loses value because the new competitor permanently reduced future cash flow, the sale may not repay the original loans. This is how equity disappears. Not because the casino paid too many ordinary jackpots, but because the market stopped supporting the cost structure built around it. The optimistic version is powerful. You own the best located casino in a protected market. The customer database is strong. Nearby population and income grow. Competitors remain limited. The hotel creates overnight stays, entertainment increases traffic, and restaurants keep visitors on site. Debt is gradually paid down. Each year, a larger share of cash flow belongs to the owner instead of the lender. Once the original construction cost is under control, a mature property with loyal customers can generate enormous recurring cash. This is the version of casino ownership that creates fortunes. The bad version is just as real. You overpay for the license. You build too many hotel rooms. The projected customers do not arrive. A neighboring jurisdiction legalizes gaming. Online casinos take part of the casual market. Promotions become more expensive. Labor and insurance costs rise. The property needs renovation earlier than expected. Interest rates make refinancing harder. None of these events has to destroy the casino alone. Together, they can turn an apparently unbeatable business into a machine that consumes cash every month. This is why the strongest operators understand that they do not own one business, they own a system. Gaming creates high-margin revenue and customer data. Hotels extend visits. Restaurants keep spending on site. Entertainment fills week periods. Conventions improve midweek demand. Digital gaming reaches customers when they are not inside the building. Each part supports the others. But adding more features is not automatically good. A billion-dollar hotel tower is useless if the market only needs half the rooms. A famous restaurant is not valuable if its losses exceed the gaming activity it creates. A concert venue does not help if the property consistently overpays performers. Crowds are not the same as cash flow. Revenue is not the same as profit. A full parking garage is not proof that the debt is safe. This brings us back to the sentence every gambler knows. The house always wins. The sentence is useful, but incomplete. The house wins across enough wagers under the rules of the game. The owner is playing under a different set of rules. The owner is betting that customer volume will remain high enough to support an enormous fixed cost structure. The owner is betting that regulators will preserve the license, that competition will remain limited, that the property will stay attractive, that marketing costs will remain rational, and that the debt can be refinanced. The player risks the money placed on the table. The owner risks the building around the table, and the building is often the much larger bet. So if you do decide to own a casino, understand what you are actually buying. You are not buying a machine that automatically takes money from everyone who enters. You are buying a heavily regulated hospitality, entertainment, data, credit, security, and real estate business wrapped around a collection of games with a statistical advantage. That advantage is real. It is also the smallest part of the story. The casino only wins after you have spent enough to bring the customer inside, keep them there, make them return, protect every transaction, maintain the property, pay the government, and satisfy the lenders who finance the building. The house may always win eventually, but whether any of that money reaches the owner depends on how much the house costs to keep standing. If you want more breakdowns of what expensive businesses really earn behind the scenes, subscribe to Money Anatomy.